2021 was really characterized by choppy markets and frequent reversals. Having said that, only 2 out of 73 HFRI indices are negative year to date, which tells you that hedge funds have actually done quite well navigating this market. It's very much been characterized by sentiment-driven, somewhat perhaps irrational markets on the equity side. And if you look, for example, at earnings beats outperformance, which typically was about 149 basis points, this year that was only 32 basis points, which shows you that managers that were trading on fundamentals had a tough time.
What do you make of what lies ahead? Because as we set up for 2022, we're talking about central bank action now, and one of the biggest fears on the markets is some form of a policy mistake. That could be market moving. Is there a chance or a risk of that?
Yeah, so look, I think getting the inflation and interest rate trade right is going to be absolutely key for hedge funds in 2022. Having said that, typically volatility tends to be quite helpful for hedge fund managers. And so I think with valuations where they are, hedge funds should be able to take advantage of that and generate quite decent returns for investors with much less correlation.
Patrick, you've used the word quite in both of your answers, quite good returns. And are they outperforming underlying benchmarks, underlying indices? That's what I want to know.
So the question is what benchmark you're looking at and whether you look at it on an absolute or risk-adjusted basis. You know, it's very difficult for hedge funds to outperform an S&P 500, for example. I mean, look at the Sharpe ratio going back to 1975 on the S&P. It was 0.6. In 2021, it's 2.4. So it's 4x what it historically has been. And, you know, that is somewhat unsustainable in our view. And it also shows you that active management will have a very tough time to sort of outperform that. But if you look at it on a risk-adjusted basis going forward, I do think that hedge funds are going to be very attractive. And if you look at periods like March of last year, for example, hedge funds have done really well. If you look at November of this year, which has been the worst months for hedge funds, it still has been much better than the performance of long-only markets. So I think you need to look at it on a relative rather than an absolute basis.
No, I disagree, Patrick. I can't eat relative tins of beans, but I can eat absolute tins of beans, or the beans in those tins as well. So I refuse to look at it on a relative basis. I'm sorry, I've had the same argument thrown at me for 20 years. I look at absolute returns here rather than I would have lost less had I done X. And why shouldn't I measure it against an index? If I'm paying 2 and 20, I should measure it against an index, shouldn't I?
Well, I think, you know, first of all, most people aren't paying 2 and 20 anymore. I think those days are over. But I think what hedge fund investors are looking for is that sort of predictability in their returns. So a lot of the clients that we're dealing with have very specific liabilities that they need to cover, and they cannot take the volatility in their portfolios. What they need is, you know, 5, 6, 7, 8% returns consistently. And what they cannot afford is to have a minus 40% a year. And that's why they're looking to invest in hedge funds.